This is the Asia Trade. I'm Annabelle, Droulers in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a positive open as investors weigh the latest Trump tariff comments. Traders also awaiting corporate earnings, inflation data from the US and key economic numbers out of China. Trump threatening financial penalties on Russia, raising the pressure for a Ukraine ceasefire. But the president says he is open to talks with the EU over his planned 30% levy. And Australia's Prime Minister set to meet with China's president in Beijing, walking a fine line between trade and security concerns.
Well, Heidi, I think you said really the top three thing that investors are going to be looking out for this morning. You have corporate earnings that are kicking off in the US on Tuesday. You've got US inflation data as well. And then you can add to that these Chinese economic figures we've got at 10 a.m. local time. So really, there is a lot of perhaps wait and see in the session today. But certainly we are expecting stocks to move a little bit higher when they come online this morning. And that is also given that we do have investors still really digesting how serious President Trump is about following through on those tariff threats and whether that door is open to negotiations, which he signalled overnight. And so you did see equity futures moving high here, which you can see reflected in the session today. As I said, Chinese economic data really one to be tracking very close. So we are expecting GDP to have held up in the second quarter. Activity figures we watch very closely as well, given you've still got those, for instance, trade-in programs, subsidies that are being affected or affecting rather retail sales. So that is really one of the key things to watch out for. Also, we're tracking long-dated Japanese bond yields quite closely, as we've seen really that big spike across the board, not just in Japan, US. We've also seen it in Europe with Japan and rather Germany and France, but essentially that concern around fiscal deficits and ballooning debt as well, Heidi.
A lot for investors to contend with, which is interesting because we've come off a period of kind of relative complacency, if you will, or at least calm. But take a look at how US futures are shaping up at the moment, given a lot of the data uncertainty, the Fed uncertainty, the trade uncertainty. S&P futures looking a little bit softer at this point, down about 0.1% there, despite still an okay lead going into the Asian session. Nasdaq futures are also a little bit off as well. Taking a look at really what is proving to be the thorn in this market side, and it's going to be really continuing to be the story when it comes to longer dated bonds. US 30-year Treasuries extending that decline. The Fed investors now turning their attention to the uncertainties when it comes to the inflation outlook. Also watching oil, which has seen a bit of a drop. We're seeing New York traded crude off by just shy of that $67 a barrel marker, with President Trump's reignition of the global trade tensions really playing on that demand side, given that we have seen quite a bit of volatility when it comes to the supply side, Bill.
Yeah, and Heidi, we've actually just got an alert crossing the terminal. It's really that a question around what governments can offer bargaining chips essentially in these trade negotiations with the Trump administration. And to that end, we've actually just had this alert coming out. South Korea is considering easing import rules on US beef, and that would be in line with reporting that we had actually a while ago, but essentially looking at food imports, reducing those to try and bring down that trade imbalance with the US.
We did actually hear from President Trump yesterday saying that he thinks South Korea wants to strike a deal, so perhaps we are seeing some of these parties coming to the table a bit more. But in the meantime, he's also threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. He's also promised to send more weapons for Kyiv, including Patriot air defense systems.
But we're very, very unhappy with him, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Let's bring our White House and politics reporter, Hadriana Lowenkron, who joins us now from Washington. So 100% secondary tariffs, more weapons being sent to Ukraine. Something of a turnaround in the president's attitude, right? But it sort of aligns with his strategy of conflating the geopolitical, the security issues with trade and tariffs.
Right, and this is something we're still trying to get more information on. When the president announced these tariffs, there was a bit of confusion as to whether when he said the word secondary, that implied to a secondary tariff or a secondary sanction. This is something we're figuring out. The Commerce Secretary, Howard Lutnick, indicated that both were in the president's toolbox, but we know from speaking with the U.S. ambassador to NATO, Matthew Whitaker, that it could be in the form of secondary sanctions, which would be on countries that are buying oil from Russia. So essentially targeting countries like India and China, which the U.S. is already working on these trade deals with. So a perfect example to your point of, the president, as he says, he uses trade for everything. And so this is a great example of mixing up the two here. And of course, we know it's a threat, but it gives 50 days. And that really is a long time. It gives Russia a lot of runway here. So we'll be following to see what ends up happening between now and 50 days from now.
Another story that has come across overnight is these tariffs that Trump is moving to impose on most Mexican tomato imports. What's the significance of that?
Absolutely. And this, of course, for some additional context, comes just a day after the president had announced a new tariff of about 17%. That is the tomato tariff, a 30% tariff rate that would kick in on August 1st, again, in the form of one of these declarative letters for products that don't fall under the North American Trade Agreement he negotiated. And this really could impact food prices. And this is something that the president is making a really, a pivotal part of his agenda here, is looking at the cost of groceries. And so that is something that we are keeping an eye on. And of course, right around the same time as the tomatoes here, we also have these new Section 232. So we're looking at tariffs on so many fronts here. We have these kind of larger tariffs, and then we have these sectoral tariffs. So really a lot that is going on all at once here.
Tomato to beef, we're just hearing that South Korea is considering easing their import rules when it comes to US beef as well. So the negotiations with some of these nations in Asia, including South Korea, Japan, seem quite far apart. Are there any signals that we could see sort of conciliatory moves from either side, but particularly when it comes to how much the White House is willing to budge?
Right, and that really is the question here. And I think it's important to look at some of the rhetoric, even as the president, gives these letters that seem very declarative. He is kind of suggesting that there is room for engagement, hoping that it would incentivize these countries to come to the negotiating table. Perfect example, the European Union. He slapped, 30%, a threat of 30% tariffs for them over the weekend, but now today suggesting that maybe there is room. And suggesting that the EU wants to talk. Of course, we're also now seeing reports that the EU is already looking at some countermeasures. And they indicated yesterday that could be the next step, right? 72 billion euros worth of U.S. goods. So again, it's a back and forth right now, and it does seem to be kind of a push and pull.
That was our White House and politics reporter, Hadriana Lowenkron there. Thanks so much for joining us. And let's talk now about how markets are weighing the latest trade developments, bringing our Bloomberg MLive strategist, Mark Cranfield. And Mark, I mean, we've been saying this for a while here, but it does seem like investors are sort of looking a little bit past these trade negotiations to an extent. How pivotal are they going to be, say, in the days ahead when you've also got to weigh that against corporate earnings and US inflation figures?
There's certainly a bit of nervousness ahead of the earnings season, but don't forget, analysts have already set a very low bar because they've already brought down expectations to the lowest for about 2 years. So it wouldn't be at all surprising if most of the big companies can beat that anyway, and we get the typical response where people going into it are a little bit cautious, most of the earnings come out slightly better, traders enjoy it, and the market can rally. Despite all the tariffs and the uncertainty about how much they are, when they're going to come in, don't forget, the United States has passed this huge tax and spending bill. That is a short-term boost to the American economy. It's good for companies as well. That's underpinning the equity market regardless of what happens with the tariffs. In fact, in many ways, it's much more important than what happens with the tariff outcome. So investors can see that there's going to be a sugar high for markets because there will be more spending in the United States. The fiscal deficit is probably going to widen further. Tax cuts are going to be embedded. So that's a feel-good factor for America. That is going to keep the market going anyway. Then the earnings season probably will turn out better than expected. So all of that will continue as the discussions go on about whether the tariffs are at this level or that level. So that's more than enough for investors to think that there's still value in US equities and that the rally can probably go on for some time yet.
Mark, how troubling is the longer end of the bond market at the moment, be it you talk about treasuries or the fiscal concerns when it comes to JGBs?
This is a global issue that is not going to go away for some time. So what you're seeing in Japan really is the microcosm of the global markets here. You're seeing that fiscal policy, the authorities in Japan are starting to lose control there. They already have a massive deficit, huge debt to GDP ratio already, and it's probably going to get even worse. As we approach the upper house elections at the end of this week, analysts are suggesting that the LDP, the ruling party, is going to lose its majority. Now, in Japan, that doesn't happen very often. Investors are very nervous when you get a change of government like that. And more importantly, it probably means there's going to be a result which is unclear. It means that Japan will be a bit rudderless in terms of leadership just when they're spending even more money. That's not good for the long end of the JGB curve. That's why you're seeing such massive steepening across there. And that's feeding across to other markets. But there are similar stories, whether it's in the US or Germany. They're all increasing defense spending. That's pushing up long-term yields as well. Deficits are going to widen across the major G10 countries. That's all the same theme, really. And that's just going to feed upon itself. There's no end in sight, really, to that, especially when monetary policy is really going the wrong way. In most places, Europe, the US, they're looking to ease monetary policy, which is not really the textbook thing to do when fiscal deficits are widening. You should be, if anything, going the other way. But that's not how it's playing out for now. Investors can see this gap. They can see that fiscal policy is overtaking monetary policy. That is not a healthy situation for bond markets. You need to price in bigger discounts in the long end of the curve. It started with Japan. It's spreading to the other major markets. There's no end in sight for it in the near term. It's probably going to get a lot worse before it gets better.
Bloomberg's Mark Cranfield there with the latest. And coming up on the Asia trade, Goldman Sachs explaining why they think China's retail sales growth may have declined notably in June. M&G investors will be along with us to tell us why they're trying to look past the current market volatility. We'll also be previewing the Australian Prime Minister's meeting with Chinese President Xi Jinping a little bit later on. Before that, though, Mizhuo CEO tells us why Japan will need to diversify away from the US amid these ongoing trade tensions. Much more ahead. This is Bloomberg.
Well, China's economy probably expanded just above the government's full-year growth target in the second quarter, and that would ease pressure on Beijing to roll out additional stimulus in the near term. So let's get more with our Chief North Asia correspondent, Stephen Engel, joining us. And Steve, I mean, it's a very big data dump we're getting this morning. Yeah. Not just GDP activity numbers, but what are we expecting?
Well, there's a lot of differing forecasts. Mm-hmm. So Bloomberg Economics is pretty bullish, but if you looked at that full-screen graphic there in television lingo, you can kind of see that the consensus is lower from the prior month. So yes, there are a lot of factors going into the Chinese economy. For retail sales, there's been a cash for clunkers trade-in programs that really has gained some traction and spurred some spending. But still, households in general are pretty cautious right now. Industrial production is picking up. Car output, if you looked at the output numbers, car output was up 14% in June, up 13% in May. But again, there's this persistent deflation still, and that's why Xi Jinping and the top leadership is talking about trying to end the price war in automobiles and other sectors. So we've had 33 consecutive months of persistent factory gate deflation. So, yes, the numbers are looking good. Yes, there's a trade truce. Yes, there was a boost in exports that we got yesterday, a record trade surplus. There was a boost as well in May, which contributed, of course, to the second quarter numbers that we're going to get later today. But there's a lot of uncertainty for sure. So Bloomberg Economics feels that GDP in the second quarter grew a robust 5.6%. The consensus, though, is 5.1%, which would be below the previous quarter. So, again, a lot of uncertainty is baked into these projections right now. So that's why we're kind of all waiting to see what those numbers are later this morning.
Obviously, the outlook depends on whether this trade truce holds, right? But what are the expectations for the second half?
Yeah, I think that you just hit it right on the head there. Will this trade truce last? Will it improve the situation? Will orders still keep coming in for those Chinese exports? Will it go the other way, go more pear-shaped? Eric Ju at Bloomberg Economics says this blip that we saw in June, of course, those numbers yesterday on the trade front were quite encouraging. He says, though, the blip might not last long. I mentioned that PPI deflation for 33 consecutive months. Well, I haven't even talked about the property market because there's been tons of rumors circulating over the last week in China about the property market. There could be another version of a Central Urban Work Conference to talk about property. The last time they convened that was in 2015. They launched that shantytown revitalization program where there was cash handouts to households who then went out and bought apartments. That sparked a nationwide property boom, which we're, of course, feeling the after effects right now of the bursting of that bubble. But there was lots of speculation. That's why we saw property stocks go up last week, that there would be a new property stimulus coming out of a new work conference. State media, though, has been pretty mum. They have not given many details on that. So, again, that would give some positive impetus to the property sector going into the second half. It's still a big, pillar of the Chinese economy. However, you look at corporate results. China Vanke Monday, yesterday, saying first half loss could be as high as $1.67 billion. So there's no end in sight to that. So I hate to, pour cold water on, again, what is momentum and some optimism in the Chinese economy, but we have to be real here. There are a lot of wild cards, the trade front and the property sector and that persistent deflation and rather hesitant spending from the consumers and households.
Just managing expectations here. Our Stephen Engle, our Chief North Asia correspondent, with the latest on China. And sticking on trade, the EU Trade Commissioner says there's still potential to continue US trade negotiations despite President Trump's 30% tariff threat. Marko Šefčovič says that the tariff letter sent by the president is triggering very strong waves in Europe. Speaking after a meeting of EU trade ministers in Brussels, Šefčovič said that the US threats are unacceptable and prohibitive to any trade.
I intend to speak with my U.S. counterparts again later today, as I cannot imagine walking away without genuine effort. Having said that, the current uncertainty caused by unjustified tariffs cannot persist indefinitely, and therefore we must prepare for all outcomes, including, if necessary, well-considered, proportionate countermeasures to restore the balance in our transatlantic relationship. I will be discussing with ministers the next steps for the upcoming weeks. I see these focused on 4 areas: negotiations, rebalancing measures, engagement with like-minded partners, and diversification of our trade.
And some of the other stories that we're following this morning, Bloomberg has learned that Saudi Arabia is seeking a strategic review of its ambitious plans to build a futuristic city known as The Line. Sources say the Saudis have asked consulting firms to review whether the 170-kilometre-long car-free city is feasible and suggest possible changes. We're told the government may decide no changes are needed and the development can continue. Fed Chair Jay Powell has asked the central bank's Inspector General to review the $2.5 billion renovation of its Washington headquarters. Some Republicans and Trump appointees have criticised Powell for cost overruns around the refurbishment project. The president has also repeated his criticism of Powell for not cutting interest rates further. A sharply divided US Supreme Court is allowing President Trump to continue dismantling the Education Department. It's lifting a lower court order that required the reinstatement of as many as 1,400 workers. The court's liberal justices dissented, warning that the decision threatens the Constitution. The ruling will apply while the case continues on appeal. We'll have plenty more ahead on the Asia trade. This is Bloomberg.
Japan's third largest bank still sees the US as a key partner despite ongoing trade and tariff uncertainty. Mizhuo Financial Group CEO Masahiro Kihara told Bloomberg how he's factoring that into his outlook for Japan's economy and bond markets.
When there is uncertainties, it's a bit hard to invest for people, right? But I don't think this uncertainty will last forever. At some point, things will be figured out, and then the rule will try to adjust. The corporates will try to adjust to a new world, and that will have a lot of opportunities for both the corporates and us too. So, I am very optimistic on what's going to happen in the future.
I mean, is this new world different from what we thought it would be? So is it different markets? Is it different trading partners?
Well, U.S. is still a very, very important partner for us. We got 100 trillion export, and among the 100 trillion, 21 trillion is to U.S. So, yeah, I mean, U.S. is still an important partner for us, but I think we will also try to diversify that. So looking to other areas is also interesting.
Are you confident in the Japanese economy overall?
Overall, I think we still have strengths in the economy sectors that we have. So I think overall, I am very confident in that. The thing is that we have to concentrate our resources in the area that we have strengths. We have high quality manufacturing, high quality products. So I think we need to figure out where the strengths are and try to sell it to the world.
Do you worry, or are there dangers actually to Japan given the spike in long-term interest rates?
Yes. So 20 years, so for the long end, especially 20 years, 30 years, there has been spike and there has been volatility. But I think the government said that they will try to shift the issuance to a 10 years or below. I think that BOJ is a little bit shrinking its QT, and I think that will help.
But is there a point where it actually starts hurting your business and starts hurting the real economy?
Well, I think BOJ is saying that the neutral rate is somewhere around 1% to 1.5%. And on top of that, 10 years will be somewhere around 2 to 2.25% then. I think that's the level that is okay. But if it goes beyond to 3% or so, that will then hurt the budget, I think.
Are you expecting more turmoil in yen, but also in the bond markets?
Not at this moment, actually. I think the current level of 1.4, 1.5 for 10 years is very. It's okay, I think. And we have. I haven't seen any turmoil in the 10-year zone. So as long as the 10-year is fine, I think it's fine.
And your thoughts on yen?
Yeah, so basically, if you think U.S. is decreasing the rates, and Japan is increasing rates, the yen should get strong. Yeah. Let's say somewhere around 135 level, probably.
That was the Mizhuo CEO Masahiro Kihara speaking with our colleague Francine Lacroix, and we'll have plenty more on the Asia trade. This is Bloomberg. Well, we're 30 minutes out from the major markets opening this morning. You can see here Sydney futures, also Nikkei futures, those listed in Singapore, though, are indicating we're going to see a slightly firmer start to the day. It's really tracking what we had on Wall Street overnight, and investors are continuing to sort of appraise President Trump's tariff threats and whether the door is open to negotiations, how wide it is as well. But big focus on the talks between Washington and the EU overnight as well. We've got corporate earnings coming out in the US, plus US inflation figures. So that's going to keep traders really busy. But also closer to home, of course, is what we're expecting in China today, because the economy probably expanded just above the government's full-year growth target in the second quarter. That would ease pressure on Beijing to roll out additional stimulus in the near term. The economy maybe got a boost from strong exports as well as ongoing fiscal support aimed at shoring up domestic demand. But let's get more on this now. I bring in Shan, Chief China Economist at Goldman Sachs. So thanks so much for joining us this morning in studio. And I mean, you can see there the amount of data we're getting out in today. But what are you going to be watching most closely, do you think?
I think data-wise, we are more or less looking at the composition, nuances, and trying to find the signals in the economy. Because for Q2 GDP, we already have April-May data, and we're just waiting for June data. So most of that is already in bag. So I think detecting how much industrial strength and the trade-in program is fading, is still going strong. That type of details and compositions will be helpful for us to understand what is really going on in the economy.
Yeah, I think industrial production is going to be one to track really closely, because you've got that big focus now on that anti-involution and corporate profits as well.
Right. So industrial production, especially in those industries that the government's looking closely for overcapacity issues, combined with PPI inflation, industry by industry, will be an interesting angle to look at quantity versus price, how much supply pressure that might be.
We know that the government probably doesn't want to fall back on the old playbook of too much stimulus, particularly at a local government level. But I do wonder, given the kind of structural slowdown elements, do you think the economy has bottomed out? Is this sort of the level of new normal growth that we can expect going forward?
Right, that's an interesting question. If you compare, for example, late last year, around the time of September policy pivot, I would say last July, August was kind of the bottom. So from a narrow local trough perspective, the economy did bottom out. At this point, what is a new normal? And thinking about all these structural issues, whether it is the latest market chatters about property sector or the chatters about anti-involution, anti-aggressive price cutting, there are institutional reasons behind those phenomena. So how do you address those in a sustainable basis? It's not going to imply any near-term you do something and immediately you see this problem solved. But over the longer term, what kind of action plan the government puts in place will dictate the future growth trajectory.
It's going to also be any action plan that they put in place around trying to boost consumer sentiment as well.
That's a more difficult question. We get asked a lot, how do you get the animal spirits or consumer sentiment up? If you look at the NBS Consumer Confidence Index, it has been pretty depressed ever since the middle of 2022. And despite the reopening, despite the last September policy pivot, we haven't seen much of improvement in that indicator. Part of me think it's just going to be a lagging indicator. It needs the economy to stabilize, it needs the labor market to improve, it needs people over time to sort of forget about all these uncertainties and difficulties and be more optimistic. So that's almost the last piece of a puzzle fall in place to have a stronger confidence.
I like that lagging indicator idea. It does seem very chicken and the egg, though. What happens in the second half? Because, of course, the expectation is we're going to see deterioration. I mean, how important are the numbers actually going to really be if you think they're going to get worse from here?
Right. I think in the second half, there are two factors that you want to watch very closely. One is, to your point, how much of a slowdown, deceleration we should be expecting in the data. We can't be sure about it because the 30% U.S. tariffs, what's going on in the global economy, it's not something we have a playbook. We can look at the historical data and predict. We know there should be some slowdown. After all, there is a sizable tariff imposed on China Chinese products, but precisely how much is difficult to be confident about. And the second is the policy response. So that factor, how much slowdown, how much the policymakers are willing to step up and offset that slowdown. That's another major factor. Judging from the latest conversations, doesn't seem like near term there will be another set of pro-cyclical stimulus coming up, because as we were seeing on the screen, that first half GDP growth looks okay relative to the full year growth target. Perhaps as we move toward end of the year, there will be more pressure to step up cyclical easing measures.
And what would that look like exactly? What would be the measures that we would put in place? I mean, because we've got the Politburo meeting coming up, for instance, it doesn't seem like anyone's really expecting any big announcements out of that either.
Yeah. I think the July Politburo meeting is interesting. On the one hand, we're not expecting much, but on the other hand, if the market is not expecting much, then any incremental news could be market moving. In terms of what they can do, I think the key question is what's the objective? If the objective is just to get Q4 year-on-year GDP growth number higher, then they could do the number of things that they did last year or in previous years, such as moving some of the infrastructure from next year to this year, doing some monetary policy easing. I think those are less sustainable in a way. It's really just about reaching the growth target and making sure the numbers are good enough. Whereas when we think about moving into later this year, the 15th five-year plan and some of these bigger picture trajectories, that's going to be more important when we look out for the coming years.
All right, Hui, thanks so much for joining us this morning. That was Shan there, Chief China Economist at Goldman Sachs. And we're going to get more analysis on China's economic outlook ahead. We'll be joined by Bank of America, Global Research and Fidelity International. That's after the June activity comes out, 10 a.m. at local time this morning. And Australian Prime Minister is staying in China, but Anthony Albanese, of course, is set for an audience today with Chinese President Xi Jinping. The meeting in Beijing comes amid Trump's tariff threats and reported U.S. demand for commitments from Canberra on Taiwan. For more, let's bring in our economy reporter, Swati Pandey. And Swati, I mean, we're a couple of days into this trip so far, but certainly there's going to be a lot of attention on this meeting today. What can we expect from it?
Yes, today is the most important day of Albanese's 6-day trip to China. So he's meeting with Xi Jinping, of course, and they're going to be some touchy topics that might be raised. So far in the trip, we saw it was all about economic and trade relationships. Now there is probably going to be the topic of the port of Darwin, which is currently leased to Chinese logistics giant Landbridge Holdings, but Australia wants to take ownership back. And that was an election vow that Albanese did before getting re-elected in May of this year. That is a topic that will definitely come up. Another topic that might come up is China's assertiveness in the region, and the point that you mentioned, Annabelle, about U.S. kind of indicating that Australia needs to choose between Beijing and the U.S. and that is a choice that Albanese will probably need to make, not today, but definitely the discussion may come up with Xi Jinping. And Albanese was asked about it yesterday at press conferences between yesterday and Sunday, and he was quite diplomatic in his responses, which he probably will be. He has said, we will cooperate with China where we will disagree where we must. That is a line that Albanese has repeated constantly over the past week or so in reference to China.
Yeah, I guess it's a question of, what he could achieve out of that talks. I mean, it's also notable, of course, that China conducted those naval exercises in the Tasman Sea back in February of this year. On the economic front, what have been the wins, I guess you could say, on that front so far?
So today we will see a CEO roundtable, which will involve Australian companies which are traveling with Albanese. So these are CEOs of Australia's biggest miners, banks, also some Chinese companies. We did hear from them yesterday at a press conference and they were talking about of iron ore, green steel, and how China's steel production is changing, how China is using more recycled steel to make steel instead of that iron ore demand that had boosted Australia's economic growth, and how Australia can now play a part in that supply chain. So that is an ongoing discussion. And also, China is Australia's #1 trading partner, so it is important for Australia to make sure that China continues to be that big trading partner, continues to buy Australian goods, and continue to see Australia as a major supplier of wines and lobsters and milk, dairy, and iron ore and coal.
Yeah. That was certainly going to be a big one to watch, that meeting between Australian Prime Minister Anthony Albanese, President Xi Jinping in China, in Beijing later today. But that was our Bloomberg reporter there, Swati Pandey, and taking a look at how commodity markets are faring this morning, because we are just seeing not too much movement so far, but certainly oil has been holding on to its decline, and traders really assessing the outlook for Russian supply. We did actually see a more than 2% drop in the session on Monday, but that is around President Trump's latest plan to pressure Russia from a refrained immediate new measures. So that is one to track. Also seeing copper a little bit under pressure as well. But we'll have plenty more ahead. This is Bloomberg. Well, some of the stories we're following around AI, and Apple is facing pressure to shake up its corporate playbook to invigorate its struggling AI efforts. Investors are urging the tech giant to break long-standing traditions to make a big acquisition and more aggressively pursue talent. Apple shares have fallen 16% this year, lagging peers such as Meta, which is spending lavishly on AI. The Nikkei is reporting that Rakuten is set to begin development next month of a large-scale AI language model. The project is said to be backed by Japan's Ministry of Economy, Trade and Industry, and was chosen through a public call for homegrown generative AI proposals. The Nikkei reports the goal is to develop an AI agent using data obtained from Rakuten's e-commerce site and its financial services. President Trump will announce $70 billion in artificial intelligence and energy investments in Pennsylvania on Tuesday. According to an administration official, the plan includes new data centers, power generation expansion and grid upgrades, and AI workforce training. Executives set to attend the launch include BlackRock's Larry Fink and the chiefs of ExxonMobil and Chevron. And the Meta CEO, Mark Zuckerberg, says the company is building a series of massive data centers to supercharge its AI capabilities. The first one, named Prometheus, is expected to go live next year. For more, let's bring in our tech reporter, Riley Griffin, who joins us from San Francisco. And Riley, Meta's got very ambitious plans around AI. So, I guess it makes sense that they also need a lot of data centers, or capacity at least.
No doubt. Meta earlier this year announced that it is building out a team of super intelligence researchers. These are people who are looking to create AI that can meet or exceed the way the human brain works. And that requires more compute. And so this latest announcement that Mark Zuckerberg made on his social platform Threads is an affirmation of that. They are going to continue to build the data centers needed to power that revolution. And as he said in that post, this is going to require hundreds of billions of dollars.
And how does that fit then, I guess, into the other investments that Meta's making to try and dominate in AI?
It's a great question. So you've got the need for compute, the actual data centers themselves, the need for energy. We've seen them make plays in the nuclear space and other clean energy forms. And then, of course, the talent. And that is where this superintelligence team comes in. Meta has been poaching researchers from OpenAI, from Google's DeepMind, from many an AI lab out here in the Bay Area. And they're putting a lot of capital to work to do so. We reported just last week that one of Apple's engineers has shifted over to Meta, and in part that was due to a more than $200 million compensation package that he was offered. So there's a lot of money at work here, and it's not just going to the data centers, but the talent as well. And we know that this year Meta is expected to spend at least up to $72 billion in capital expenditures, with a large focus on AI.
Are there any concerns that Meta is getting from investors about just these efforts that they're spending? I mean, this whole idea around superintelligence is something that people might say could never happen. Do they have any sort of pushback?
Yeah, it's amazing to see Wall Street really isn't disturbed by the amount of capital going to this effort. Meta, as you may know, is really driven by revenue from advertising on Instagram and Facebook and WhatsApp, its family of apps. And so it's got a lot of cash on hand to deploy. Wall Street is really excited to see the AI investment at a time where the AI race is hot out here in the tech world. And as for concerns, I would say the concerns we're hearing most about are internal to Meta. They've felt that they have been a laggard in this race so far, particularly in April after its Llama model was released, and disappointed both internal researchers and a lot of the external AI community.
You mentioned internal. What about, and this is sort of a bit of a wild card question, Riley, but have you heard anything about maybe some internal dissent around the pay packages that are being offered to these new recruits?
Well, we know not everybody has taken the pay packages. There's been some reputational hurdles that Meta has had to overcome. I've myself, speaking with folks in and around the industry, have heard from folks who are concerned about some of what they described as gimmicky plays in the past by Meta to venture into the AI space with certain chatbots after celebrities and so forth. So there is some reputational baggage that comes with Meta's AI efforts, but I think they're trying to shed that here with a new bench of talent.
All right, and certainly talent that's coming on maybe with a lot of T's and C's attached to those big pay packets as well. But thanks so much for joining us. That was our tech reporter there, Riley Griffin, and taking a quick look at how crypto prices are faring in the session today, because, of course, it's that big focus that we're continuing to see on Bitcoin. You're very close to that 120,000 mark right now, which it did actually breach overnight for the first time ever. But it does really seem that investor enthusiasm around the asset class generally is kind of showing a few signs of abating. But you do have the U.S. House of Representatives, preparing to consider some key industry legislation. So that, of course, if we do get any progress on that, would add some fresh fuel to the rally. And, of course, a clear U.S. regulatory framework is something the industry has been asking for a long time. But we'll have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade, where we just have an alert crossing the terminal this morning. This is in response to a Trump administration move overnight to withdraw from a long-standing trade agreement with the Mexico government, or governing rather the import of tomatoes, and it's going to be pushing forward, the Trump administration said, with a new tariff of just over 17%. So that announcement came on Monday from the Commerce Department, essentially moving to impose a 17% tariff on most Mexican tomato imports. We're just getting the reaction now from the Mexican government, and they're saying that they are calling this U.S. decision on tomatoes anti-dumping, that deal unjust. They're saying as well that they've rejected, or that rather that the U.S. has rejected proposals on tomatoes for political reasons, and they are going to continue seeking an accord with the U.S. on tomatoes. But this is something that does actually risk substantially impacting food prices. Let's shift now to Panasonic, because it says its new Kansas battery plant is on track to hit full production later this year, despite reports of a delay due to slowing demand. Its North America chairwoman and CEO also told us exclusively that they remain committed to supporting all customers, including Tesla.
So this is more than a 10-year vision. We wanted to do this, and we wanted to go big in this market. So we had a commitment, and we started in Reno, Nevada, and this is our factory that we're diversifying our EV strategy, and we're going to be full production this year, and it's really exciting. Today's a fun and exciting day, and this is a celebration.
Full production this year?
Yes.
So cells are already coming off the line?
Yes.
Could you just explain the roadmap for the ramp? Because no facility is straightforward, but this is the size of 200 American football fields. How are you going to get to full capacity this year?
So we started in November 2022, 2.5 years ago, and it was all flat field, and it was a massive land, and we started the construction, and we started the production and testing last week, and we're going to produce the batteries this year. And you probably saw the cars that we have in display, and Tesla, Lucid, and Hexagon truck. And we're really excited to work with different suppliers and partners and clients this year.
We're going to discuss in detail those customers. They're really key to this. There were media reports Friday night that there would be a delay in reaching full capacity, and what the report stated was that was due to demand. Are you able to comment on that report? And it sounds like they were misinformed if you are going to hit full capacity this year.
I do think it was misinformed, and we're a Japanese company, and when we say, when we commit to something, we're fully committed, and we want to make sure that we support all the customers that we're committed. We're not feeling the slowdown yet, and we're very, very bullish on working with all those customers.
When you say you're not feeling the slowdown, that means that you're seeing consistent orders from those key customers, or they're still committing to orders in advance? What do you mean by the definition of what you just said?
So we have the operation in Reno, and that's going very healthy, and we're seeing the commitments coming in for this facility as well. So we're not feeling the slowdown yet. But yet again, I mean, you see this operation, this is a long-term commitment. So there may be some pushback or moving ahead, but we're committed for a long term, and we're not shying away from those from time to time challenges.
That was the Panasonic North America CEO Megan Myung-Won Lee speaking exclusively with Bloomberg's Ed Ludlow. And we're approaching, of course, the open of trade in Japan and Korea, Australia as well. But certainly as we come online this morning, we're going to be watching those long-dated Japanese yields very closely. We actually saw them leading the drop in that dated tenor. But essentially, it's that big question around the fiscal spending of governments, those widening deficits. But ahead of the open here, we are expecting equities to just open fractionally higher, tracking Wall Street. Lots of data to focus. US inflation. We've got earnings kicking off. China data as well at 10 a.m. local. This is the Asia trade, and we're counting down to Asia's major market opens this morning. Really big focus in the session on trade, of course, and what President Trump was saying overnight around Europe in particular, sort of opening that door still to negotiation. So that's going to be something to track. But of course, it's also corporate earnings, US inflation figures, and the China data we've got coming up in a couple of hours. Busy day.
Yeah, and big question as to how this sort of tariff environment is going to feed through the outlook for earnings, right? I guess we'll know sooner rather than later. But as you said, trade sort of is overshadowing everything, including even the geopolitics, with President Trump now threatening tariffs and secondary levies on Russia if this ceasefire doesn't happen, and quickly.
Yeah, we just got the open here this morning, and we're going to be watching to see how the Nikkei actually starts to come online this morning. There you can see in the green as we kick off the day. So tracking what we had overnight on Wall Street, a big focus in the session as well on those longer dated Japanese bonds, because we saw the really big moves at the long end of the curve yesterday. That 30-year yield, for instance, lots of questions around the health of Japanese fiscal deficits. So you can see here yields continuing to move just a little bit higher in the session. What we are tracking as well is any commentary we get around the expectations for hiking, and we've actually just been speaking with an ex-BOJ chief economist, saying that he sees the odds of a rate hike as soon as October. But that is, as we come online this morning, also the Japanese yen. We're seeing it fairly steady, but 147 or close to 148 against the US dollar. Taking a look as well at Korea this morning, because as we said, that big focus on trade in the session, and we did actually just get some commentary this morning from local media in Korea, and the key takeaway from this essentially is that they are looking at easing some of their restrictions on imports of US beef, aged actually 30 months or older. But the key takeaway again is just that governments are continuing to try and find ways that they can work with the Trump administration. You are seeing the cost be a little bit under pressure so far in the session, but we have seen lots of index upgrades coming through, and lots of investors as well really liking this value up program.
Belle, take a look at what we're setting up when it comes to just that staggered start to trading here in Australia. And, of course, the focus is really on geopolitics and China-Australia relations with Prime Minister Albanese in Beijing today. He is meeting with President Xi Jinping as well as Premier Li Qiang throughout the course of the day. So we'll be watching for any kind of readouts and developments when it comes to that fine line that is being tread between, of course, the biggest trading partner and some of those perhaps more conflicting security positions, right? But at the moment, we're seeing a pretty good start out of the gate when it comes to Aussie stocks, up by just about 0.5% there. The Aussie dollar also holding on to some of that proxy China strength as well, perhaps still feeling a bit of the giddiness from the export numbers out yesterday. Of course, we do have, as you mentioned, that big China domestic activity data dump later on today as well. And watching really bonds, not really on the short end, but certainly on the longer end, that's continuing to cause consternation both with treasuries and JGBs over that fiscal situation. But Aussie bonds looking like we're going to be pretty tightly bound in the session today, Bill.
Yeah, but there is really a lot to keep investors on their toes, you could say. And our next guest says that he's trying to look past the current market volatility as much as possible. Joining us from Singapore is Vikas Pershad, Asian Equities Portfolio Manager at M&G Investment. So, Vikas, thanks so much for your time. Where do you see then the biggest or the best opportunities right now?
Good morning, Bella. Good morning, Heidi. Always a pleasure to be back. We see opportunities across all of Asia. Markets have been much more resilient than we would have anticipated at the start of the year. Had somebody told us, well, this is what's going to happen. You're going to have Liberation Day. You're going to have continued conflict. You're going to have sell-offs in German bonds, Japanese bonds. But that said, we see opportunities in Indian equities. We see opportunities in Chinese equities in Japan. And fortunately, given the sell-off at the end of last year, we were positioned well for the rally that we've seen in Korea. So those fit four large markets, but there are opportunities all across Asia, Southeast Asia as well, Australia and New Zealand. It's just a matter of looking. The ECM activity has picked up. You're seeing a record number of, record value of IPOs in India this year. That surprises me, given the pace that we saw last year. And ECM activity is picking up in Hong Kong, China again. So there's opportunities everywhere. We also are subject to this crisis fatigue that seems to have set in across markets and for companies as well. They're trying to get back to business as usual, and that's leading to opportunities all across the region.
When you say crisis fatigue, I'm also curious about perhaps this level of complacency that we see amongst some investors around the risk that Trump really does follow through on some of these tariff pledges. Do you think that markets are maybe underestimating that threat?
They might be now, and it's a good duality. This is a crisis fatigue on one side, and the need to maintain vigilance and not be complacent on the other side. I think markets reacted in early April the way one would have expected the markets to react, given the magnitude of the news and the headlines that we saw around tariffs. And since then, what we've seen is market participants, companies trying to look forward and look past this. If you look at earnings estimates across the region, they really haven't changed very much since the end of March. It depends on the sector. Now, Haidi was talking about the bonds in Japan earlier. The insurers, they'll start reporting earnings soon. We got to watch what they report and how they guide. So these moves will make their way into earnings. Broadly, however, markets have been pretty resilient.
Since you mentioned bonds, I wanted to get your weighing when it comes to when the worries, when it comes to really longer-dated global bonds, are going to start petering through to the outlook for equities, or at least the sentiment for equities.
I think it should start now. These moves are material, and I mentioned the insurance sector as one. We saw that last quarter. We saw the Japanese insurers report large losses because of what was happening in the bond markets, and those moves are even more exaggerated now. So the June quarter just concluded. Companies will start coming out with their guidance. So there's that, but then also just broadly for the market sentiment, I would be surprised if it's not weighing on it. It depends on the market. It depends on the sector and the companies. Everything is company specific. There are some countries where we detect less worries. India is one of them. In the Indian market generally is seen as largely domestic, largely on the right side of trade negotiations with the US. There's a very powerful domestic growth story underway there. But we see that in Japanese earnings. We see many things to like in China and, of course, South Korea as well. So opportunities across the region. This divergence that we had seen between the US and the rest of the world, perhaps we were a little bit early to start talking about it 2 to 3 years ago. Our view was that this divergence would reverse, we'd start to see convergence, and that will last for a long time. And it will be led by Asia. So far, so good.
As we are having this conversation, Japanese 10-year government bond yields rising to the highest since 2008. These ongoing concerns about fiscal spending, the upper house election, of course. Some of the consternations over Japan, do you think it casts a shadow over the outlook for Japanese equities for you?
Not in the long term, but even though we are long-term investors, of course we manage our portfolios on a daily basis. We're heading into the heart of earnings season very soon, so this will lead to some volatility. Our view, however, is that actually volatility is our friend. The enemy is velocity. If you go back to early April, the volatility that we saw post-Liberation Day, that set us up quite well for the next few months. What was not helpful, however, was the velocity, the speed with which the recovery happened, whether it was in India, which is the first major market to erase its early April losses, or if you look at the tech sector, you look at the large cap tech names in the US, same thing happened in Japan. So for us, as long-term investors, volatility is a friend. It should be for any long-term investor. The issue is velocity. That has become our enemy, and that's what we're dealing with as investors who manage portfolios at scale.
Vikas, always great to chat with you. Amidst all of this ongoing uncertainty, Vikas Pershad, who's the Asian Equities Portfolio Manager at M&G Investments. One of the sectors we'll be watching will be oil stocks in the day's session, and we are seeing Goldman Sachs raising their second half Brent price forecast by $5 to $66 for the new forecast there. We have seen that focus really kind of renewed for oil markets back onto Trump's trade war and these ongoing risks of tariffs for demand, particularly out of key markets, the likes of India, the likes of China as well. At the moment, we are seeing crude just sort of holding on to most of its drop. It has slumped by more than 2% just in the Monday session alone. Largely, that was driven by Trump's threats over Russia and potentially 100% in secondary levies if the Ukraine ceasefire doesn't progress more quickly from here, really aimed at potentially also hindering Moscow's energy exports as well, Russia refraining from some of these immediate new measures. So we continue to watch crude, but we have had Goldman Sachs just raising their second half 2025 Brent forecast by $5 to $66. More ahead on the Asia trade, this is Bloomberg.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
That was President Trump on threatening to impose stiff financial penalties on Russia. And let's get more on this now, bring in our news desk editor, Jill Desis. And Jill, it's not just about the penalties that Washington can apply on Moscow. I think one of the most interesting points out of this is more these secondary sanctions and how they can hit the trading partners.
Yes, that's right, Val. Because, I mean, when you're dealing with, just straight trade between the U.S. and Russia, it's not really a factor right now. I think it's much more about that idea of those secondary sanctions. It's a little confusing. When you're listening to Trump, he kind of uses the term secondary tariffs here, but we've heard from the U.S. NATO rep that it effectively means secondary sanctions. And so that's the idea of, if you're implying, tariffs or sanctions on Russia's allies, particularly looking at places like China and whomever, if they're continuing to do business with Russia, if they're continuing to do trade with Russia, if they face the threat of U.S. sanctions, I think that's sort of a much more effective threat in that regard. I will also point out that this is something that Trump is not, it's not just Trump that's threatening this. There's also the U.S. Congress. They've put together a bill. I think the secondary sanctions or tariffs, or however you want to word it, would come up to about 500% on some of those allies. So, really kind of serious stuff in the works here. Trump has indicated that, he's not really sure how this is going to all go down. Maybe he can do something via executive order or some kind of executive power. Maybe he, does want the help of Congress. But I think what this ultimately represents is a pretty significant ratcheting up of pressure on Putin and Russia. We know that Trump has been pretty disappointed with how ceasefire talks have gone over the last several months. If you recall, during his campaign, he was trying to push for an end to the war in Russia and Ukraine within the first, 24 hours or so of him becoming president. Obviously, that's not happened. You're hearing him in that clip express his disappointment to Putin. And what he's kind of done now is give Putin this deadline of, I think he said early September or so, where he's really trying to force that ceasefire deal. I'm not sure that, threatening these kinds of sanctions is ultimately going to be what pushes Putin there. But you do, I think, I think ultimately what this is symbolizing is really that tension between the U.S. and Russia that does seem to be heating up a bit.
You question the likelihood of success, but it does very much square with President Trump's strategy of putting the security, the geopolitical, the trade issues all on the table at the same time to try and, kind of leverage off each other, right?
Yes, and I think what we're seeing that Haidi is with the way that that Trump talks about all of the other trading partners, right? We're still kind of in the midst of Trump throwing out all of these trade letters worldwide, kind of telling these countries, telling, and in some cases, honestly, like the U.S.'s closest allies, that they basically have to come to the table, accept this deal. Maybe there's a few that he's in the way of negotiating with, but yeah, I do think that it kind of shows. Yes, you've got Trump is very, very committed at this point on his policy. He's got this vision for how he pretty much wants to upend global trade. He's got a lot of really kind of clear national security commitments that he's trying to make. And I think what you're seeing here is a fairly emboldened Trump trying to sort of really push forward on a lot of the policy agendas.
And it seems like any product really is on the agenda. Tomatoes, for instance, is the latest one overnight, and this is talking about imports of Mexican tomatoes. We've heard the response from Mexico as well this morning.
Yeah, look, I think, again, you were seeing this earlier this year, too, when it came to, all kinds of threats that Trump was putting on, some of his more neighborly trading partners. We saw this with Canada, looking at oil, copper, all kinds of different imports there. I think at this point, Trump has made really clear that he wants to play hardball with these trading partners, trying to bring them to the table. I think in some cases, it's clearly, he's gotten, something of an effect of a lot of trading partners saying that they do want to, negotiate better deals with Trump. I think the question is just, how much Trump is actually willing to kind of come forward with there, because when you've got places like the EU, for example, saying that these latest 30% tariffs that Trump is threatening basically would really, really, really hurt, if not completely upend transatlantic trade. Is Trump, is that something that ultimately kind of, affects Trump? Kind of unclear. Earlier this year, we saw him, stave off of pursuing some of his trade plans because the bond markets, obviously took that very poorly. Trump does seem to kind of react to market reaction. And maybe that's what it takes, is that it would have to take something, a little bit more severe there. But yeah, again, it does seem like he's pretty committed to following up on a lot of these tasks right now.
Our Bloomberg News Desk editor Jill Desis there with the latest on trade. Let's take a look, and Jill mentioned the sort of still open a door, just a crack in the door when it comes to potential negotiations with the EU, both expressed by President Trump, but also on the EU side as well, in terms of a potential ability to continue negotiating, even as the EU targets the likes of Boeing, American cars, bourbon, with a list of potential tariff targets there. But we are seeing a little bit of optimism, potentially, when it comes to President Trump saying he's open to continue talks with the EU. There's a bit of upside both across German DAX futures and broader Euro Stoxx 50 futures there, Belle.
Yeah, and I think what's interesting, Heidi, is that, yes, you've got this open door to negotiations. It's also those domestic political pressures that we see in some countries that sort of constrains their ability to strike a bargain as well. And we've seen that in Korea, but also in Japan as we look ahead to these upper house elections later this month, where we're also seeing the market implication from that is very much in the 10-year yield this morning, because you've got that has climbed to its highest level since 2008. But certainly there's these big worries really around fiscal spending, given you've got the ruling party proposing cash handouts and the opposition as well planning lower taxes. So that is a very clear market reaction that we're seeing to that in the session today. But on that point, Japan's third largest bank sees the US as a key trading partner despite ongoing trade and uncertainty. The Mizhuo Financial Group CEO Masahiro Kahara told Bloomberg how he's factoring that into his outlook for Japan's economy and bond markets.
When there is uncertainties, it's a bit hard to invest for people, right? But I don't think this uncertainty will last forever. At some point, things will be figured out, and then the world will try to adjust. The corporates will try to adjust to a new world, and that will have a lot of opportunities for both the corporates and us too. So I am very optimistic on what's going to happen in the future.
I mean, is this new world different from what we thought it would be? So is it different markets? Is it different trading partners?
Well, U.S. is still a very, very important partner for us. We got 100 trillion export, and among the 100 trillion, 21 trillion is to U.S. So yeah, I mean, U.S. is still an important partner for us. But I think we will also try to diversify that, so looking to other areas is also interesting.
Are you confident in the Japanese economy overall?
Overall, I think we still have strengths in the economy sectors that we have. So I think overall, I am very confident in that. The thing is that we have to concentrate our resources in the area that we have strengths. We have high quality manufacturing, high quality products. So I think we need to figure out where the strengths are and try to sell it to the world.
Do you worry, or are there dangers actually to Japan given the spike in long-term interest rates?
Yes. So 20 years, so for the long end, especially 20 years, 30 years, there has been spike and there has been volatility. But I think the government said that they will try to shift the issuance to a 10 years or below. I think the BOJ is a little bit shrinking its QT, and I think that will help.
But is there a point where it actually starts hurting your business and starts hurting the real economy?
Well, I think BOJ is saying that the neutral rate is somewhere around 1% to 1.5%. And on top of that, 10 years will be somewhere around 2 to 2.25% then. I think that's the level that is okay. But if it goes beyond to 3% or so, that will then hurt the budget, I think.
Are you expecting more turmoil in yen, but also in the bond markets?
Not at this moment, actually. I think the current level of 1.4, 1.5 for 10 years is very. It's okay, I think. And we have. I haven't seen any turmoil in the 10-year zone. So as long as the 10-year is fine, I think it's fine.
And your thoughts on yen?
Yeah, so basically, if you think U.S. is decreasing the rates, and Japan is increasing rates, the yen should get strong. Yeah. Let's say somewhere around 135 level, probably.
Mizhuo CEO Masahiro Kahara there speaking with our colleague Francine Lacqua. For more ahead on the Asia trade, this is Bloomberg. Well, the crypto rally continues with Bitcoin briefly topping $123,000 for the first time. Investor appetite seemingly remaining strong. It comes as Crypto Week gets underway in the U.S. House of Representatives with lawmakers set to debate key digital asset legislation. Let's bring our crypto reporter Subhashri Ghosh. So, Subhashri, what are we seeing as the drivers of the rally? Why is there conviction among the bulls that, this time it's for real? And I guess what could come out of Crypto Week that could support that?
Exactly, you rightly said that this time looks like people are expecting this time to be a different kind of a rally, which is kind of underlined by expectation that the regulatory clarity is expected to come out from the U.S., which is the world's largest crypto market. And as you rightly said, that this is a crypto week that the U.S. Republicans have termed, and key legislations, including the stablecoin bill and the market structure bill. These are going to be some of the bills that will be possibly put to vote in the House of Representatives, and that's bolstering the underlying sentiment that finally there will be some regulatory clarity, and overall people can, investors, traders, builders, everybody can take positions accordingly in the market given the regulatory clarity. So that's the basic essence which is really turbojetting the Bitcoin market, in contrast to whatever is happening in the other parts of the other assets in the financial world. I would also like to add that this is mostly a Bitcoin-led rally rather than spilling over to the altcoins, the so-called altcoins, which are like the smaller tokens, right? So that has to be also taken into consideration, because it's not like all across the board rally. It's mostly concentrated on Bitcoin, and the reason being it's pretty much a one-way lane, really, Heidi, when it comes to Bitcoin demand, but not really the same case can be told for other smaller cryptocurrencies.
And I guess an asset most likely to be held by institutional investors. But how much of this is priced in right now, or is Bitcoin poised for a sustained break high from here, Suva? Just briefly.
Yeah, absolutely. Bitcoin looks like to be poised to a strong breakout from here on. People are expecting $150,000 on the Bitcoin to be the short-term break, the next all-time high, and then again another by end of the year, $250,000 on Bitcoin is many of them are actually pricing in already for end of this year. So yes, it looks like a one-way lane really for Bitcoin, and obviously there can be some profit booking in between, and the tariff protectionism could work through as well, but more or less a one-way lane looks like from here.
Wow, Suva, if you're saying 250 possible by the end of this year, you're certainly going to be very busy. But that was our crypto reporter there, Suva Ghosh, and we'll have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade and taking a look at how markets are faring here. We're 30 minutes into the session for Japan, Korea and Australia. And we are seeing stocks here mostly moving to the upside. So that's still that optimism from President Trump saying he is open to negotiations, particularly with the EU. That's hitting sentiment. But also a bit close at home, of course, is the moves we're seeing in the government debt space this morning. But the JGB 10-year yield climbing to the highest level that we've seen going all the way back to 2008. The concern here really is around fiscal spending ahead of a key election later this month. So that is that there. We will get more details on that in a few minutes from now. But also, as we said, that big focus on trade in the session, corporate earnings, US inflation figures, and importantly, investors are waiting for Chinese eco data as well, because the economy probably expanded just above the government's full-year growth target in the second quarter, and that would ease pressure on Beijing to roll out additional stimulus in the near term. Let's get more with our Chief North Asia correspondent, Stephen Engels. So, Steve, I mean, lots of different data coming through this morning. The question, of course, is what does this mean? How much worse does it get into the second half as well? But the expectations for today.
Yeah, let's get into the second half in a little bit, in the second part of this report, because the last half saw some ups and downs, definitely on sentiment because of the trade war with the Trump administration, then the two truces, if you want to call it that, and their impact, obviously, on the trade numbers we got yesterday was very encouraging. And that's why you're seeing a discrepancy in some of these analyst forecasts for second quarter GDP growth. The consensus is for 5.1%, which would be a pullback a little bit from the first quarter of 5.4%. Bloomberg Economics, though, thinks the economy gained momentum at a faster pace at 5.6%. Industrial production higher than the consensus estimate as well from Bloomberg Economics. Retail sales also higher than the consensus estimate. Regardless, as you can see the numbers there, that's the survey, that's the consensus estimate. Regardless, 5.1%, combine that with 5.4% actual in the first quarter, puts the Chinese economy on pace to surpass the government's full-year target of around 5%. That would average out to about 5.3% GDP growth throughout all this uncertainty and the volatility, obviously, on the trade front. And that basically indicates there might be less urgency right now for policy movement. There has been some stimulus to encourage spending. The Cash for Clunkers program, the trade-in of appliances, has been perhaps better than expected. That has stimulated some consumer demand, but still households continue to be cautious, and persistent deflation exists for 33 consecutive months at the factory gate. So there are stresses in the economy for sure, but there's encouraging signs.
It's really hard to crystal ball gaze when we don't know what's happening on the trade truce, right, and how reliable that is.
Yeah, so the second half is a wild card completely. So there's good momentum going in as we are now into the second half of the year. And that's a good thing. But again, as Eric Ju, the economist at Bloomberg Economics, says, this might this blip might not last long because, again, there's so much uncertainty on the trade front. We don't know if the trade truce will build onto better things or possibly unwind. So there's some front loading, obviously, of orders going on the trade front. That's why we saw that record trade surplus as well in the last month in June. And whether that can continue on exports and imports going forward, we simply don't know. And we haven't even mentioned the property market, which continues to be a downward drag on the economy. We'll get new and used home prices also today as part of the data dump, as we call it colloquially here. Residential property sales will also have a separate indicator, and also property investment numbers. There's been a lot of chatter in the markets in China over the last week or so about this possibility of a Central Urban Work Conference to focus on major stimulus in the property sector. The last time that big body convened in 2015, we got the Shantytown stimulus, which gave cash out to households to go buy apartments. That was 2015, so 10 years ago. That led to the property bubble that we saw obviously unwind over the last couple of years, but it worked in the first place in that it stimulated property demand. So that has not been indicated in state media, so some of that optimism towards that kind of stimulus has faded over the last week.
Yeah, it is a really big question because, of course, we've seen just a number of steps to try and revive the sector, but so far sort of seeming to have limited success. But that's our Chief North Asia correspondent, Stephen Engel, there. And we can stick on the property story, of course, because after we saw home sales extend their slump, lots of focus on the data later today. But chief among the developers, well, that are at risk is the embattled builder China Vanke, which has deeply apologised for its performance in the first half of 2025 as losses threaten to reach almost $1.7 billion. Let's bring in our China correspondent, Min Min Lo in Hong Kong. And Min Min, just put it in perspective for us. I mean, how significant are the scale of these losses?
Yeah, this loss is now going into the second year now, and it's quite significant because it's widening from the previous year. The first half year losses estimated to be 10 to 12 billion yuan, compared to the same period a year ago, that was about 9.8 billion yuan. And this really underscores, the property crisis now dragging into its fourth fourth year or fifth year now, despite some of the government stimulus, which has seen quite modest success. But still, you look at Vanke, it's seeing sales, a decline in the scale of its real estate project settlements, profit margins remaining quite low. And we did see the June data that came out last few weeks ago, showing home prices and home sales both going down. So Vanke has, in some ways, it has escaped, the risk of default after it got, sort of bailed out by the controlling shareholder Shenzhen Metro, which provided new rounds of financing for the company. But still, the fundamentals remaining quite weak at the moment.
Hong Kong real estate giant New World Development is also having trouble when it comes to completing a loan.
Yes, New World is missing its self-imposed target for July 11th to complete this deal that is led by Deutsche Bank. And we understand from sources that it was, that the existing lenders are not too keen to increase their exposure to the company. So Deutsche Bank is having to look for new lenders. And New World had just successfully secured a new round of financing last month, $11 billion loan. Now they're looking for new financing, a smaller scale loan of about 4 billion Hong Kong dollars. It could be increased to about 15 billion Hong Kong dollars. And of course, investors are watching this very closely because its ability to close this loan, it would have impact on its future financing challenges. So something we're watching closely. It's currently looking to offload some of its properties as part of the agreement from the previous refinancing agreement. But again, this is a company that has very strong levels of liquidity pressure, given that it's highly indebted, one of the most leveraged companies among Hong Kong developers. Its net debt is about 95% of its equity value, according to Bloomberg Intelligence as of last December.
Bloomberg's China correspondent there, Min Lo. We are watching Japan bonds, or in fact, we're watching really long-end bonds more broadly on a global level. But the 10-year in particular is in the spotlight, with the yield rising to the highest since 2008. These ongoing concerns about fiscal spending ahead of the upper house election this month. So there's political and fiscal worries playing. We saw that 10-year rate raising 2.5 basis points there. The 20-year bond yield also hitting the highest since the year 2000 on Monday. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. And, we were speaking earlier about how perhaps Japan is looking like a bit of a microcosm in terms of the trend that we're seeing across other global bonds as well. But particular to this is the sort of focus on the fiscal situation and looking at the budget.
Yeah, the fiscal situation in Japan is definitely of concern. We've got the upper house elections coming on the weekend, expected to be very bad for the government, and that the response there might be to ramp up what's already some very strong fiscal outlays. That raises issuance concerns. The level of concern about issuance at the long end in Japan is highlighted by the fact that the MOF recently moved to reduce the amount of issuance at the long end, precisely because they were worried about how those auctions were going. So that's a big part of what's going on. But it's also, Japan is very much a microcosm for the global, major global bond markets, all of which are facing, in particular, fiscal concerns. That's exacerbated by the signs of sticky inflation, and we're all still waiting to see if, when, and how severely the tariffs impact U.S. inflation in particular. So Japan is the most exposed at the moment, but we've still got lingering concerns about what might happen with bonds, what might happen with gilts. They've had a lot of problems lately, and what could happen with U.S. Treasuries. In particular, we've got both CPI later on today in the U.S. session, which is expected to accelerate. If it accelerates more than is anticipated, that could set off some major damage for treasuries. And we do have PPI coming along later this week for the US, which could also, even if CPI passes without too much incident, PPI would still be a risk. So the setup for bonds is not great because of this combination of fiscal concerns, both globally and also in isolation in a number of markets, and that backdrop of still lingering worries that inflation is reluctant to come low enough.
Yeah, you mentioned the damage that we might see from the US inflation print later today, but just spell it out for us a little bit more, the gyrations that we could see in treasuries.
Well, there'll be a lot of attention to the 30-year Treasury. That is still in striking distance of the 5% area, which has been, a major trigger point for not just sell-offs in bonds, but also for contagion to equities, because when yields get high enough, that's a concern both directly for the relative value of stocks, but also for what the higher borrowing costs will do to the bottom line going forward. We've also got one of the factors that's playing into the picture with the US debt is the way that they've been moving forward on the so-called SLR reform, which would allow banks to hold more treasuries than they currently can without having to set aside money for risk and so on. So that should open up fresh sources of demand for treasuries. However, swap spreads have barely budged. So there's a sign there that effort to shore up demand is not really helping. And when you've got these inflation concerns and these supply concerns after Trump's tax and spending bill was passed, that all creates a fragile pattern for treasuries. And remember, we have had a number of occasions over the past few years where liquidity suddenly evaporated in the treasury space. So a higher than expected inflation print today could set off some of those gyrations, and in particular if we get lumpy trading because buyers just step right back, we could get a lot of damage not just to treasuries but also, as I said, bleeding across to equities.
All right, that was Garfield Reynolds there, who leaves our Markets Live Asia coverage. And of course, that big focus on the US inflation figures. Also a big watch on China's economic outlook, because we've got the GDP figures and also the monthly data dump coming up at 10 a.m. local time, so just over an hour's time from now. But we'll get the reaction to that from Bank of America Global Research and also Fidelity International, joining us after those figures are released. But we'll have more ahead on the Asia trade. This is Bloomberg.
Australian Prime Minister Anthony Albanese is set to meet Chinese President Xi Jinping later today in Beijing. The meeting comes against the backdrop of President Trump's tariff threats, US demands for more defence spending and commitments on Taiwan. Albanese would need to walk a fine line between Australia's biggest trading partner and its most important long-term security ally.
One of the things about Australia and China that's so important is that we build people-to-people relations, and we do that by the participation of Australians here, whether it be here in football, whether it be the business relationships that we have here as well. I've brought with me a whole range of business people from the resources sector, the tourism sector, from the education sector.
Let's get more when it comes to the expectations from the PM's visit to China. I'll bring in Darren Lim, Senior Lecturer in the School of Politics and International Relations at the Australian National University in Canberra. Really great to have you with us. And sort of on the one hand, we've seen bilateral relations improve markedly compared to just a few years ago. On the other hand, the global environment and some of the demands when it comes to diplomatic finesse and balance are really more challenging than ever. How fine is that line that the Prime Minister has to tread on this visit, given the amount of perhaps diplomatic deft that is really required?
It's a very fine line, but at the same time, this visit is happening in a context where both sides, I think, want a successful visit. The chaos of the Trump administration is giving Beijing a significant opportunity to play the calm, reasonable leader and to welcome Australia, after a few years of relationship turmoil. On the Australian side, of course, the emphasis here is on economics, it's on jobs, the Prime Minister's domestic economic agenda, which is very much enabled by a strong trading relationship with China. So I think both sides want to accentuate the positive, albeit in the context of significant differences on many other issues.
how thorny are some of the regional geopolitical issues, be it any sort of clarification on Canberra's positioning on Taiwan, which of course the Prime Minister did give this week, but also some of the concerns over what's viewed as Beijing's overreach in the South China Sea, in the Pacific, some of the islands.
As you say, there are a range of issues. We've seen the Trump administration put pressure, it seems, on Australia to clarify its position on Taiwan. And the Prime Minister and other political leaders have done a good job of batting that one away and reiterating the government's position that it supports the status quo and will not entertain hypotheticals. And I think that's a reasonable position that everyone would expect. On the broader geopolitical issues like the South China Sea and the Pacific, look, I think both sides have their positions. They're well understood. They will be raised, but I don't expect that they will be a major source of irritation. Much more likely is the specific bilateral disputes that the countries have. For example, the Darwin port lease, which the Prime Minister promised during the recent election campaign to cancel from a Chinese company and return to presumably Australian ownership. That's the kind of thing that might cause more of an irritation when the two leaders meet today.
But would you see sort of any shifting in positions? I mean, it sort of seems unlikely given the expectation is that both want to have a positive trip as well.
I think both sides understand that they are required to ventilate their grievances, their differences. There is an expectation among the Australian public and the Australian media that we will raise some of our disputes. The plight of Dr. Yang Hengjun, a democracy activist, Australian citizen who is in jail in China. Our concerns about China's military build-up and the lack of transparency, which of course Foreign Minister Penny Wong raised with her counterpart in Malaysia last week. So these things are required to be said, but is there an expectation that Australia can move China on these issues? Probably not. And so both sides will go through the motions on these disputes, but try to shift things to the positive agenda as quickly as possible.
One thing that also could come up, though, is more on the economic side, and we've seen some MOUs or deals possibly being signed, but there's also that key sticking point of China wanting more access to the Australian economy that maybe Canberra also isn't willing to hand over.
Yes, this is a really interesting evolution, I think, in the economic relationship, because for a very long time, Australia was able to enjoy what I would call arm's length trade with China. We can sell our resources, we can sell our food, we can welcome Chinese tourists, but these transactions aren't very intimate, right? They don't involve an ongoing relationship. What China wants, of course, is more direct involvement in the Australian economy through more foreign investment, especially in our resources sector. But we've also seen China's ambassador to Australia say that perhaps artificial intelligence might be included in the free trade agreement. And this, of course, brings back memories of Australia being the first country to ban Huawei from our 5G network back in 2018. The Australian government wants to keep China at arm's length. We are not very trusting of Chinese technology and the relationship between Chinese companies and the state, and we prefer, of course, to keep sensitive investments in minerals, out of Chinese control as well, for a whole host of reasons. And that, I think, is the real sticking point here. That desire for a more intimate economic relationship, a tighter embrace from Beijing, which would potentially lead to more influence down the track, and Australia's effort to keep the economic relationship robust but at arm's length.
We've seen legal action being commenced over Northern Minerals, essentially. Do you think the strategic, politically key issue of rare earths, Australia's opportunities, China's stranglehold is likely to become a contentious bilateral issue?
Look, it's very hard to say with certainty. Australia has got a significant interest in developing its processing capacity in rare earths, and it sees a great opportunity to contribute to the friendshoring economic security initiative of the United States and other partners. At the same time, we do need Chinese technology, and China remains the world leader in rare earths processing. So there are both opportunities and risks in this sector, and I think I don't expect that this to play a significant role in this particular meeting, but it's going to be an ongoing irritant, but also source of potential growth into the future.
Darren, thanks so much for joining us this morning. That was Darren Lim there, Senior Lecturer in the School of Politics and International Relations at Australian National University. And we'll have more on Australia Ahead. That's every Tuesday at 10:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find that on Apple, Spotify, or Bloomberg.com. More ahead on the Asia trade. This is Bloomberg. The latest on the corporate front this morning, and Meta CEO Mark Zuckerberg says the company's building a series of massive data centers to supercharge its AI capabilities. The first one, named Prometheus, is expected to go live next year. Zuckerberg says the company is going to invest hundreds of billions of dollars into data center capacity to achieve machine superintelligence. Apple is facing pressure to shake up its corporate playbook to invigorate its struggling AI efforts. Investors are urging the tech giant to break long-standing traditions to make a big acquisition and more aggressively pursue talent. Apple shares have fallen 16% this year, lagging peers such as Meta, which is spending lavishly on AI. Nikkei is reporting that Rakuten is set to begin development next month of a large-scale AI language model. The project is said to be backed by Japan's Ministry of Economy, Trade and Industry, and was chosen through a public call for homegrown generative AI proposals. Nikkei reports the goal is to develop an AI agent using data obtained from Rakuten's e-commerce site and its financial services.
Take a look at how we're setting up when it comes to trading across Greater China when markets open in sort of the next half hour or so. We did have, of course, a bit of a boost when it comes to some of those export and import numbers coming in yesterday, but the domestic activity numbers will be the ones to watch today, given that we have some signs of gaining of momentum in the 3 months through to June. A lot of uncertainty as to whether this trade truce with the US will hold, but certainly we're expecting a pickup when it comes to broader GDP growth, perhaps a little bit of uncertainty when it comes to retail sales, fixed asset investment likely expanded, along with industrial output as well. That is just about it for the Asia trade. Our markets coverage continues.